Imagine a piece of dirt, not a country, not a state, just a single piece of land right in the middle of Tokyo, roughly the size of a few golf courses. Now imagine that this specific patch of dirt, the grounds of the Japanese Imperial Palace, is mathematically valued higher than all the real estate in the entire state of California combined. Every house in Beverly Hills, every tech campus in Silicon Valley, every beach house in Malibu, add it all up, and it is worth less than one palace garden in Japan. Does that sound like a math error to you? Welcome to Tokyo in 1989, the peak of the greatest, most absurd financial bubble in human history. At this exact moment, Japan is not just an economic miracle. It is a financial monster eating the global economy alive. Japanese corporations are not just selling you cars and Walkmans anymore. They are taking their infinite piles of cash and buying up the very soul of America. They bought the Rockefeller Center in New York. They bought Columbia Pictures in Hollywood. They bought the Pebble Beach golf course. American politicians are sweating on national television, warning that Japan is about to financially colonize the United States. And the craziest part is, the math actually backs them up. The top 10 largest banks in the entire world are all Japanese. The Tokyo Stock Exchange is bigger than Wall Street. It feels like an unstoppable empire of wealth. But wait, where is all this money coming from? Did the Japanese suddenly invent a machine that prints pure gold? How did a nation that was completely devastated just 4 decades earlier suddenly have enough spare change to buy Manhattan landmarks purely for bragging rights? To understand how a nation of islands managed to inflate a financial balloon so massive it threatened to swallow the earth, we have to rewind the clock just 4 years earlier. The year is 1985. The Plaza Hotel, New York City. The United States is incredibly annoyed. American factories are shutting down because everyone is buying cheap, high-quality Japanese goods. The US dollar is simply too strong, making American exports too expensive. So, the US, along with Britain, France, and West Germany, pulled Japan into a room and forced them to sign a piece of paper called the Plaza Accord. The deal is simple. Japan must artificially make their currency, the yen, much stronger against the dollar to level the playing field. And it works perfectly. The yen absolutely skyrockets in value. But there is a massive, immediate problem. A super strong yen means Japanese products suddenly become ridiculously expensive for the rest of the world to buy. Toyota, Sony, Panasonic, the crown jewels of the Japanese export machine, start screaming. Their global profits are falling off a cliff. The Japanese government panics. They are completely terrified of an economic recession. They need to save their companies immediately. So, the Bank of Japan does the only thing central banks know how to do when they are scared. They grab the interest rate lever and they yank it all the way down. They slash rates aggressively, pushing them down to a historic low of 2.5%. They open the monetary floodgates and drown the entire banking system in an ocean of cheap cash. The logic is simple and well-intentioned. Make money incredibly cheap to borrow, so struggling companies can survive the export shock. Invest in new equipment, and keep the domestic economy moving forward. It sounds perfectly reasonable. It is the textbook economic solution taught in every university. But the central bankers vastly underestimated a fundamental force of nature, human greed. Because when you make money this incredibly cheap and easily available, people do not use it to build boring factories or invest in slow, steady research. They use it to gamble. And the commercial banks? They completely lose their minds. They are no longer acting like careful, calculating guardians of capital. They are acting like frantic salesmen trying to meet an impossible quota. Bank managers are literally knocking on doors, begging ordinary citizens and small business owners to take millions of dollars in loans. You want a loan for a new car? Take $1 million. You want to start a business? Take 10 million. The streets of Tokyo are practically paved with liquid cash. Salarymen are waving 10,000 yen notes in the air just to hail a taxi to go exactly 2 blocks. Companies are hosting lavish parties on yachts, flying in chefs from Paris, and buying solid gold golf putters just because they can. The entire nation is suddenly drowning in cheap, borrowed money, and all that money is desperately looking for a place to go to multiply itself. And this is exactly where the loophole is discovered. This is where the textbook economic policy mutates into a mathematical nightmare. But instead of investing in factories or technology, Corporations and ordinary citizens discovered a cheat code to infinite wealth. They poured every single yen into the stock market and real estate. The Nikkei stock index began a vertical climb that defied gravity, eventually hitting an astronomical 38,915 points. Companies with zero growth were suddenly worth billions. It was absolute euphoria. To understand how completely unhinged this got, I need to explain the core mechanism of this bubble. Imagine you're playing a game of Monopoly. You buy a tiny, worthless property for $10. In a normal economy, you wait for someone to land on it to collect rent. But in this 1980s Japanese system, the bank walks over to your property, looks at it, and says, "We think this is actually worth $100, and we will lend you $100 right now if you use it as collateral." So you take the $100 and you buy a second property. The bank instantly appraises that second property at $1,000 and hands you a $1,000 loan. You use that to buy a third property, which they value at $10,000. You're not creating any actual value. You're not producing anything. You're just stacking debt on top of debt. This was the exact loophole the entire nation exploited. It was an infinite money glitch, a feedback loop of pure, ungecked greed. The banks lent money based on inflated land prices. Borrowers used that cheap money to buy more land, which pushed the prices up even higher, which allowed the banks to lend even more money. It is a mathematical house of cards, and the only thing keeping this entire structure from collapsing was one dangerous cultural myth: the belief that Japanese land prices could never go down. Everyone believed that because Japan is a small island nation with a massive population, land was a finite resource that would only appreciate. It was treated as a law of physics. Because of this blind faith, banks stopped caring about cash flow. They stopped asking for business plans. If a company asked for a loan, the only question the bank asked was, "Do you own any land?" If the answer was yes, they handed over a blank check. Car manufacturers and electronics giants realized they could make more money trading real estate and stocks than actually selling cars and televisions. They called it Zytech. For financial engineering, Japanese companies were borrowing money at 3%, buying financial assets that paid 5%, and simply pocketing the difference. It was free money. A tiny parking spot in the Ginza district could sell for over $1 million. The entire economy transformed into a giant casino where everyone was winning and nobody was checking the math. The balloon was stretched so incredibly thin that a single sharp object would cause an explosion. Enter Yasushi Miyano. In late 1989, Miyano became the new governor of the Bank of Japan. Unlike his predecessors who wanted to keep the party going, Miyano was a traditional, conservative banker. He looked at the astronomical property values, the runaway stock market, and the massive mountains of hidden debt, and he saw a catastrophic crisis waiting to happen. He knew the balloon was going to pop. The only question was whether he would let it pop on its own and destroy the entire banking system, or if he would take a needle and pop it himself to control the damage. He chose the needle. Miyano decided it was time to take away the punch bowl. He aggressively slammed the brakes on the cheap money machine. Over the next year, he violently raised interest rates over and over again, pushing them all the way up to 6%. He issued strict government directives ordering commercial banks to immediately cap their lending to real estate speculators. He forcefully turned off the money printer. The flow of cheap gas into the balloon was completely cut off. The party was officially over. The oxygen was sucked out of the room. And this is the exact moment the math catches up with the madness. The Nikkei stock market took one look at the new interest rates and went into a complete and utter freefall. The euphoria vanished instantly. On the very first trading day of 1990, the market began a catastrophic descent. Within a single year, the index plummeted by nearly 40%, wiping out over $2 trillion in paper wealth. It was absolute carnage on the trading floor. But the stock market crash was just the appetizer. The main course of economic destruction was the real estate market. Remember that infinite money loop we talked about? The one where you use land as collateral to borrow more money to buy more land? That entire mathematical equation only worked if the land value kept going up forever. But when the cheap money disappeared and interest rates spiked, nobody could afford to borrow money to buy land at those astronomical prices anymore. The buyers simply vanished. The market completely froze. And then the foundation cracked. Property prices began an agonizing, decade-long slide. eventually losing up to 80% of their peak value in major cities. That million-dollar parking spot in Ginza, it was suddenly worth less than the luxury cars parked inside it. The grounds of the imperial palace were no longer worth more than California. The entire foundation of the Japanese economy, the sacred land that everyone treated as guaranteed, risk-free collateral, turned to dust overnight. And this is exactly where the financial system truly broke. The commercial banks, the ones who had recklessly handed out billions of dollars based on those inflated land prices, suddenly realized their collateral was practically worthless. If a corporate borrower defaulted on a $10 million loan, the bank could seize the property, but they could only sell that land for maybe $2 million. Multiply that scenario by tens of thousands of loans across the entire country. The banks were staring down a terrifying black hole of catastrophic, systemic losses. But instead of admitting defeat, restructuring the debt, and taking the painful loss right then and there, the Japanese government and the banking sector did something incredibly dangerous. They decided to hide the truth. They engaged in massive accounting tricks to conceal the bad loans from the public. They kept these technically bankrupt institutions alive on financial life support, creating an army of zombie banks. These zombie banks were terrified. They completely stopped lending money to new, innovative companies because they were too busy trying to cover up their own massive, toxic failures. The entire flow of credit in the real economy simply stopped. The dynamic, unstoppable engine of the Japanese economic miracle completely seized up. The results were devastating and lasted for generations. Corporations that had borrowed heavily to speculate during the bubble years were suddenly trapped under mountains of debt they could never mathematically repay. To survive, they slashed costs ruthlessly. They stopped hiring new graduates. They stopped raising wages. They spent the next 20 years doing absolutely nothing but paying down their old bubble-era loans. This painful, prolonged era became known as the Lost Decade, which eventually stretched into 2 lost decades. It was a period of severe economic stagnation, crushing deflation, and shattered dreams that deeply scarred an entire generation of workers who had simply followed the rules. The math had finally exacted its brutal, unavoidable revenge. When a financial system is built on infinite leverage, cheap central bank liquidity, and the sheer delusion that asset prices only go up, the collapse is never a matter of if, but exactly when. It is a harsh, objective macro lesson about the fatal combination of manipulated money and human herd mentality. And as we look around at modern global markets today, from heavily leveraged real estate sectors to the wild swings of cryptocurrencies and tech stocks, looking at how much cheap money has been printed over the last few years, you have to ask yourself one very chilling question. Are we blindly inflating our own balloon right now, just waiting for a needle? Thank you for watching. If you want to understand the hidden macro forces shaping your money and avoid the next crash, do not forget to subscribe and leave a comment below about what historical bubble we should cover next.